Bayesian analysis is the math of change. It's the math of updating a guess. And any Stats 101 student can tell you about Bayes' theorem for partition events. You know, the classical, is a component going to break down given what vector it came from, with steady state probabilities. Like any math theorem, it came from old dead dude who said it worked at some point in time. His name was Thomas Bayes. He was a reverend, mathematician, and a philosopher. He said that nothing is actually known. Events are purely observed. We don't actually know that the sun's going to go up because we're told it. We've purely seen it go up every day in the past, and therefore can estimate that tomorrow our best guess about the situation of whether the sun's going to go up or not is given by our past observations of it going up. In doing this, he took a non-parametric approach to classical statistics and said that no distributions or parameters of them are actually known. We're purely playing Plinko with observations. If I flip a coin 100,000 times, most people in here would say it's probably going to fall pretty close to 50-50 over the grand scheme as n goes to infinity for you math-proofy people. If I'm looking at the distribution of the physical attractiveness across the room, we have my beautiful mother in the back corner, falling in at about a 7 or 8. We got a troll mongrel, baldy father, about a 2 or 3 maybe. I'm a pretty average guy. I think there's a lot of people better looking than me. I think there's a couple people worse looking than me. Maybe I'm a 4 or 5. Keep on doing this over the course of forever, you're going to get a normal curve centered around 5 with everyone that ever lived. So, what Bayes does is he says that the more pieces of info we get about a situation tells us more about the situation and the true parameters that are assumed constant in classical statistics. Therefore, he says that any new information or beliefs about a system need to be factored in to the parameters of the system in order to accurately forecast these parameters. In math notation, his posterior exterior, which is the state of an event at the conclusion of this time period, is what we thought about the event at the last time period, updated for what we've learned since then. This is the basis for any updating technologies. Siri, your autocorrect popping up your 3 most frequent words that you've used texting. The Roomba robot that goes across your house and vacuums your floor until it hits a wall. As soon as it hits a wall, it'll turn a corner. Or rockets. You're shooting at a planet here. You aim that way. Now you're here. Now you need to aim that way to get here. Now you're here. You aim that way. In doing this, there's 2 periods. There's now and then. Then we were here. Now we are here. What have we learned since then? That's the likelihood of XT. What have we learned since then? So what does our normal curve about the American attractiveness population tell us about being on a Hollywood cast? I've never been on a Hollywood cast, but even though I have no prior data points for that situation, I could probably guess it probably has a sample average higher than 5, is my best guess. Therefore, even though I don't have any prior knowledge or Plinko balls to drop in this intrinsic distribution I have in my head, I think that the normal curve centered at 5 needs to be updated to more accurately represent a shift towards the direction up. He said this. So, what Bayesian does is allow us to approach the actual parameter with a directional adjustment. So what we knew yesterday is basically what we thought was true yesterday is what we knew was true at the end of the day, or what we assumed to be true, just like classical statistics has null hypothesis. If I go on a date with a girl and I thought it went pretty well and I want to go out there again, at the end of that first date, I'm going to think I want to go out there again because I thought she was okay. I assume that holds true through the prior of XT. I go out with her because I thought she was pretty okay. Those are one and the same. when she starts talking about how she wants 8 kids and 12 cats, I update my posterior XT to reflect not going out with her again because it's a poor investment of my time. In doing this likelihood function, achieving the mechanism of directional adjustment on your posterior best guess at the situation at the conclusion of the time period can be achieved purely with a time series of the magnitude and direction of your last errors, how far off you were, and the direction. If you're so interested, you're free to ask me, and you can see my 23-page proof of that. This gives us some cool mathematical properties in that now, instead of taking the double integral of a bivariate normal dartboard, we can purely take a time series of the magnitude and direction of how far you missed each throw. So we come to my final parsimonious model. It's my second favorite math word, parsimonious. For Bayesian updating, which is my guess about tomorrow is my guess today, updated for what I learned since then. In doing this, we have all these discrete data points. Therefore, every input into my model is a discrete time series value. This allows us to time series forecast parameter values instead of basing them on parametric calculus assumptions with continuity. In reality, here's every presentation that I've ever given. Here is, what's your name, bud? Tim. Tim's presentation went this long. We were told it was going to go give or take 25 minutes. The error between the 25 minutes that we were told we get between what he got intrinsically shifts how long you think my presentation is going to take in your head. If he goes 5 minutes, you guys are all happy because I'm probably more likely to get out of here and stop rambling at you a little bit quicker. But if he goes for an hour and a half, you guys are going to be rolling my eyes because he missed way high, and your expectation of how long I'm going to take is going to be much higher than that 25 minutes. Also note that this likelihood function is purely this discrete point and what was learned over the course of his presentation. Our brain and Isaac Newton's notions of continuity play tricks on us, and they try and connect the dots. But in reality, it doesn't matter what he's saying during the presentation. It's not over until the fat lady sings. And the only thing that is relevant to our prediction about the next period is the conclusion. Therefore, justifying that the errors completely cover everything that is achieved by Bayes' likelihood function. Also, keep in mind that our posterior, our guess at this, is assumed true, just like the classical null hypothesis, until Tim gives us evidence for a directional adjustment. If he hits the nail on the head and there's zero error, then we don't need to readjust our guess, and this carries true. The sun goes up today just like it went yesterday. I still haven't reevaluated my guess as to if the sun's going to go off. But the error terms will then point a direction needed to adjust. This gets me into least squares methods, which we all have to learn them. 263 right now. You having fun doing multiple regression? There you go. Least squares and the idea of homoscedasticity, the idea that yesterday is as varied as today is as varied as tomorrow will be, is great for a lot of situations that approach steady states. Just like rolling dice, just like video games. They have a finite sample space and it's unchanging. If I'm making a bet, we got gambling people out here? If I give you $1 for every time I roll a 1, 2, or 3, but you give me 50 cents for every time I roll a 4, 5, or 6, you're going to take the bet every time because it has a positive expected return in your favor. No matter how many times I roll that dice, over the course of time, it will approach steady state, and those probabilities of each side, you're assuming it's not going to roll 1 through 3 every single time. If I roll it once, and then I stop the bet and I win $1, you're going to be frustrated because you didn't allow the steady state to be reached as n approaches infinity. However, life isn't steady state. Things are dynamic. You can't model based on parametrics or the notion that yesterday is as varied as today is as varied as tomorrow will be. Therefore, life in and of itself is a heteroscedastic time series. You can look at these qualitative examples I keep on bringing up. If you'd like quantitative, read my report. Here's a stock we expected to spike based on a market event, happened right around then. We test the classical null hypothesis of homoscedasticity against the alternative hypothesis that homoscedasticity does not hold true in every case, and therefore is not a good framework to build on. That can be tested with a simple f-test. Take any two arbitrary chunks. If their variances are significantly unequal, then it becomes very dangerous to model purely least squares and homoscedastic. That's a big word. That's my favorite math word, get into that. Homoscedastic assumptions. Therefore, I attempted to rewrite the classical notion of confidence intervals with a non-parametric time series approach that attempts to catch this discrete value one period in the future. Our graph from before, everyone, you're getting 262, 263 people back there, remember classical confidence intervals. You have a point estimate, which is your expectation of your posterior guess formulated at exactly this time. That's your point estimate of the state at one period in the future. Your point estimate is then purely a center point for a net that you throw, plus or minus equal distant from that point, in order to ensure that you actually could catch the actual state. Now, since your second part of your margin of error is classically the standard deviation of the parameter estimate, now with this discrete time series of errors, your standard error is purely your expected miss. My standard error from a parameter estimate is how bad I expect to be wrong, which is the forecast of your next error term. Expected error at time plus 1. Given how confident you want to be, 90, 95% confident, and how many of these standard errors you expect to branch out plus or minus a mean. In doing this, we can keep it non-parametric. We don't have to assume homoscedasticity, and we can maintain the classical confidence level of how confident you want to be about catching the actual state of a situation at the conclusion of one time period. Here's my forecast for the very heteroscedastic gas prices. If I was using models from 30 years ago, I'd probably be a little bit disappointed, but updating those models, that's what I've come to. The last model I would like to talk about from a Bayesian perspective is the capital asset pricing model for all the finance people in the audience. What this does is it calculates an expected return from an asset or portfolio based on some theoretical risk-free rate and the difference in risk you assume. The difference between your expected return from the market and your risk-free rate, think like a treasury rate or a bank account, anything you have a probability close to 1 of achieving at the end of the period. Times this beta multiplier, which is the risk you assume in investing in that asset relative to the intrinsic risk of taking place in the market. Typically, these markets are a collection of assets large enough to employ the central limit theorem. Think the S&P 500, think Dow Jones, think anything large enough to approach normal means over the course of time. In doing this, it assumes that your risk is holistically modeled by variance. How much it's bounced in the past relative to how much the market has bounced, and the direction. So therefore, your beta in the classical capital asset pricing model is how much it has bounced, assuming it will continue to bounce like that in the future. This makes a lot of bold assumptions in and of itself. Just like that, past variances will continue homoscedastically in the future, and also covariances will continue. A couple other assumptions I'd like to talk about are that investors are identically broadly diversified. They're risk averse, which means they like low variances. They share the same perfect information, same assumptions, and same investment horizon. Each of these is a classically continuous random variable in and of itself. The probability that two investors in a market would have the same of any of these is 0 in that reason. So the probability that they all do is extremely more 0. In and of that, there's one. Also, it assumes that sales are instantaneous and taxes are instantaneous and also commission-free. There's no taxes. There's no commissions to be had with brokers. If you look at the stock market, that's never true. You can't ever buy a stock at the exact price you're always paying commission. If you buy something from a store, there's always tax. It also says they are price takers who can lend and borrow unlimited amounts at the risk-free rate. If you ever go to a flea market, you don't necessarily have to be a price taker. If you ever go to a garage sale. Also, the idea that anyone can lend and borrow unlimited amounts at the risk-free rate can purely be observed in looking at my student loans. The last thing that you math-minded people might find interesting in this is that our expected return of an asset is, in fact, a significant function, is significantly correlated to this expectation of our market. Here's one more classically continuous random variable, and in that it has a probability of 0 of at least one input into that model actually being correct. So with the last piece of the model I'd like to look at is this notion of a beta, this multiplier based on risk. The risk-free rate, the treasury bond, a bank bond, has a beta of about 0. Something that's twice as risky as the market has a beta of 2, moving in the same direction as the market. Something that has moved in opposite direction of the market with exactly the same variability has a beta of -1, and on and on and on. The usefulness of this assumes that future market and asset deviations are going to be normally distributed. Bayes took massive issue with parametrics in and of themselves. They make nice assumptions and they look good on paper when you can say that 68% of future returns will fall between 1 and -1 standard deviations of a mean. In real life, that doesn't always happen. It also assumes that past covariances are expected to continue at the same amount and direction. This assumes that correlation equals causation, and just because something is dipped together in the past, it will dip and rise together in the future. This is the same as the notion of me staying off the streets every time I see an ice cream truck, because murder and violent crime has been directly correlated to ice cream sales. So, what I propose is my last non-parametric alternative to the capital asset pricing model. I do this by drawing on ideas of physics rate problems in rate in versus rate out, So my expected return from any asset, qualitative or quantitative, is my expected gains before the conclusion of the time period, which I call T, minus the expected losses from that asset before the end of the period. I chose whole dollars as a better marker for actual returns, as they tell you more about a situation, a quantitative situation than percentages do. I'd rather get a percent of $1 million rather than 2% of $10. Therefore, if you fix your required return from this asset, then, and you can factor in the very real transaction costs, time value costs, tax, and also other costs. I bought a bike. I have it on Craigslist. I bought it. I wouldn't sell it for less than $700. I put a brake master cylinder on it. The master cylinder cost me $20, and I value my time at $30. I would therefore not sell it for less than $750. You can factor all these costs into required return. Therefore, the acquisition cost either has a probability of 1 if you actually buy it, or 0 if you don't buy it, and therefore the model wouldn't be relevant if you don't buy it. So this has a probability of 1, assuming you already purchased or are holding the asset. This is my final model. If you're still holding buggy whip stock 100 years ago, hoping you bought it at $10 and you're hoping it'll get to 11. Sorry, Ford and cars probably said otherwise. This top part will zero out. This probability of your asset actually hitting your $11 is going to approach 0. Top part will zero out, and your expected return in that situation is just your negative cost that you paid back in the day. Time value of money is intrinsic to your head. However much you think it was worth to lose those $10 a share back in the day, value today is intrinsic to the person. They're never given, they're never fixed. So, all in all, classical models are great for situations with static probabilities. Flipping cards, rolling dice, video games. The sample space is finite, and you already know everything that could possibly happen. But life is non-parametric. We need to account for this in modeling with non-parametric components of models. Neither is it heteroscedastic. Variance yesterday is not the variance of today, nor will it be the variance of tomorrow. Heteroscedastic components also need to be factored in. Otherwise, not accounting for these in predictive models can really be detrimental. If you model based on parametrics and homoscedasticity, could be very harmful. Ask any Enron employee. So I got some extra credit for my problem. Just got the answer. It's $1 for the winner. What's the answer?
Diabetes.
There you go. Keep my point in that is sometimes algebra and classical models don't get the bigger picture. Always forecast relative to the bigger picture, not what old school models say. Every model is wrong. Some models are useful. I think Bayesian analysis provides a useful directional adjustment to classical models. And me.
Any questions from the speaker?
Pretty interesting. How do you apply what you did to some real life situation beyond determining whether it can take this curve?
Definitely. I have 2 semesters worth of projects on this. If you look through my report, I just didn't want to bore people with quantitative. We were forecasting that stock model, and the stock was for a very volatile new market. There had been no previous companies in that market. we expected an event that happened on January 1st to bubble stock prices. We didn't know that for sure, but we expected it to. We did this with dummy variables. The dummy variable was 0, dormant the whole time, up until that market event flipped on, it turned to 1. That spikes that, but like I said, regression models are very flawed in the period outside of the expected bubble. So what we did is we took our classical, it was an ARSIS model, a simple, exponentially smooth time series model, assumed least squares and everything for the part where it was docile. We had that component of the model and a regression component with the 0 and 1 dummy variables to account for the bubble. And we weighted them by recent performances in that there was a alpha and 1 minus alpha weights attached to each individual forecast. In doing that, the weight of the forecast was shifted from the classical to the Bayesian during the period of the spike. And then after that, after the Bayesian lost, after it went back to homoscedastic, it was pretty docile, it would shift the weight of the prediction back to purely a time series classical model. And in doing this, our constructed semi-parametric model outperformed 11 other classical models. And I can provide you that report if you care so much about the numbers.
And how did you choose the place to change from the parametric to the non-parametric?
Our company in question was a cannabis industry, which are publicly traded. The market event on January 1st, 2014 was the first day in Washington and Colorado that cannabis was sold legally. Didn't know what would happen, but investors are like sharks in water. They smell blood and they jump, and they bubble, and they overvalue all the firms. It happened once before, and it will probably happen in the future. We saw it once, and we tested the significance of the bubble with classical t-distributions. The mean price before January 1st and the mean price directly after January 1st. And in 11 cannabis-related firms, all were significantly different at an alpha of 1%.
So I'm still not, unless I misunderstood you, you had a parametric part, then a non-parametric part, and then you went back to the parametric. Is that right?
The weights up front,
Yeah.
we had a classical ARSIS prediction.
Right.
It would forecast the price at t+1. We had this component, and we weighted it with alpha.
Right.
This alpha, these add up to 100%, was weighted on our regression forecast. This one had Bayesian, it was 0 and 1s to account for the bubble. So this one is very parametric, central limit theorem, least squares. This alpha was a measure of each model's performance in the recent past. So it was the percent error in the ARSIS over the percent error from both. These were recent. I arbitrarily picked a period of 4 months or 4 weeks. If it did better with this arbitrary 4-week period, it can probably be optimized and therefore suggest that a mixed model is optimal over both of them. Absolutely. And then it just shifts these weights. So our final forecast was this whole thing, purely with shifting weights. Ideally, one model overshoots it, the other model undershoots it, and the weights sandwich in between to approach the actual value.